Welcome back to iSpy Academy and to Lecture 3, which covers key financial instruments. This session is all about the tools, the assets, the contracts, the structures that allow us to take action in the financial markets. Whether you're trading, investing, or managing long-term wealth, understanding financial instruments is essential to building your edge. We're not just learning definitions here. We're going to explore how these instruments behave, how they interact, and most importantly, how to use them responsibly within a broader portfolio strategy. So let's jump in. First, you'll be able to clearly identify and define key financial instruments, from ETFs and mutual funds to options, bonds, REITs, and more. We'll then talk about how these instruments differ from one another, both structurally and strategically. After that, we'll take a portfolio level view. How do you use these tools to manage risk, capture opportunity, and align with your personal goals? And finally, we'll reflect on something that often gets overlooked, your personal bias around what feels safe or risky. By the end, you should be thinking less like a consumer of financial products and more like a strategist. So let's start with a foundational question. What exactly is a financial instrument? At its core, a financial instrument is simply a contract, a structure, something that holds monetary value and can be traded or held to achieve a specific financial goal. That could mean a share of stock, a US Treasury bond, an ETF, even a derivative contract like an option or a future. If you can buy it, sell it, or structure it to access or transfer value, it's a financial instrument. And that's the key. These tools are not just passive holdings. Traders and investors actively use them to accomplish things. You might use a sector ETF to gain exposure to a group of companies in a theme you believe in. You might use bonds or REITs to create a steady stream of income. You might use options to protect against market drops, or to amplify returns in a low capital environment. Let's break down the core categories of these instruments to better understand what's available to you. Here's a quick roadmap of what we'll be unpacking in today's session. We'll start with equity instruments, which include things like individual stocks, mutual funds, and ETFs. These are probably the most familiar to most investors. Then we'll explore debt instruments, primarily bonds and treasury ETFs. These are about lending money and earning interest. After that, we'll dip into the world of derivatives like options. These can amplify gains or hedge against losses, but they also carry complexity. And finally, we'll explore alternative instruments like REITs, commodities, and currency ETFs, which give you exposure to the real-world economy in creative ways. This mix is what lets you build a complete portfolio, one that's balanced between growth, income protection, and diversification. Let's kick it off with a fan favorite, exchange-traded funds or ETFs. They have become one of the most popular financial instruments in the modern investing world. So what are they? An ETF is a collection of assets, often stocks or bonds, bundled together and traded under a single ticker. That makes them act like a portfolio, but trade like a stock. For example, SPY tracks the S&P 500. If you buy SPY, you're getting instant exposure to 500 of the largest US companies without having to buy each one individually. That's one of the big draws of ETFs. They give you diversification in a single purchase. Real-time pricing, unlike mutual funds, which only price once a day, flexibility and liquidity, so you can trade them throughout the day. They're used by both long-term investors and short-term traders, which makes them one of the most versatile tools in the game. Let's take a closer look at some examples and what makes each ETF unique. When evaluating an ETF, it's important to look at three things. What index or sector does it track? What kind of exposure does it give you? And how might it fit into your strategy? Let's break these down. SPY. This one tracks the S&P 500. It's the core US market, large cap, broad exposure, great for general growth. QQ tracks the NASDAQ 100. It's more tech heavy, more growth oriented, and also more volatile. XLF, this one's focused on financials. It's often used during sector rotations when investors think banks or insurance companies are about to move. Mark, now this one's different. It's actively managed and focused on innovation, high risk, high potential reward, but also higher drawdowns. Each ETF tells a story. The question is, does that story match the market environment you're in? And the goals ETFs are flexible and transparent. But what if you want access to professional management, especially in a retirement account? That's where mutual funds come in. Mutual funds are the original diversification tool. And while ETFs have become more popular, mutual funds still play an important role. The biggest difference? Mutual funds are actively managed and are usually designed for long-term investors. You don't trade them during the day. They're priced once daily at the net asset value or NAV. They often come with higher expense ratios, but you're paying for management and strategy, not just market exposure. For example, VFIAX is a passive mutual fund that tracks the S&P 500. It's like the mutual fund version of SPY. FMAX, on the other hand, is actively managed and focuses on growth stocks. Mutual funds are often found in retirement accounts like 401ks because they fit the needs of longer-term hands-off investors. So if ETFs are like a self-serve buffet, mutual funds are like a pre-planned meal. You trust the chef to take care of it for you. Now let's shift gears to one of the most powerful and potentially dangerous tools in the market, options. Options are one of the most flexible and misunderstood instruments in the financial markets. At their core, options are contracts. They give you the right, but not the obligation, to buy or sell an asset at a set price before a certain date. There are two types. A call option gives you the right to buy an asset. A put option gives you the right to sell it. So why use options? Leverage, you can control a large amount of stock for a fraction of the price. Income, some traders sell options to collect premiums, like generating passive cash flow. Protection, you can hedge your downside. For example, buying puts on SPY if you expect a drop. But here's the warning label. Options are powerful, but they're also complex. They're not beginner friendly, and using them without a full understanding can lead to serious losses. That's why we'll be dedicating a full future session to advanced option strategies. Now, from paper contracts to physical exposure, let's talk about real estate in your portfolio through REITs. REITs, real estate investment trusts, let you invest in real estate without owning property. They're companies that own or finance income-producing real estate. Think commercial buildings, apartment complexes, data centers, and warehouses. Why do people like REITs? They tend to offer high dividend yields, steady income. They can serve as an inflation hedge because property values often rise when prices do. They give you exposure to a non-correlated asset, which means they don't always move the same way stocks or bonds do. Some examples, known as the monthly dividend company, focuses on commercial real estate, VNQ, a diversified REIT ETF that holds a basket of different REITs. PLD, focused on industrial real estate, especially warehouses and e-commerce hubs. Just remember, REITs can be volatile and they're sensitive to interest rate changes. So they offer income, but they also come with risk. Speaking of interest rates, let's dive into the world of bonds and bond ETFs. Bonds are debt instruments. When you buy a bond, you're essentially lending money to a government, a municipality, or a corporation in exchange for interest. But instead of buying individual bonds, many investors use bond ETFs. These let you invest in a basket of bonds with different time horizons. There's an important relationship to understand here. When interest rates rise, bond prices fall. When rates fall, bond prices rise. Duration matters too. The longer the bond's maturity, the more sensitive it is to interest rate changes. Some examples: TLT, 20-plus year treasuries, high duration, high sensitivity, IEF, 7 to 10 years, more moderate, SHY, 1 to 3 years, lower duration, less volatile. These tools are useful when you want to preserve capital, balance equity risk, or add stability to your portfolio. Now let's talk volatility, specifically how to trade fear itself through the VIX and volatility products. Now we're entering one of the most psychologically charged areas of the market, volatility. The VIX, also called the Fear Index, measures expected volatility in the S&P 500 over the next 30 days. When the VIX spikes, it usually means investors are nervous and markets are dropping. When it falls, it reflects calm or complacency. Now, you can't trade the VIX directly, but there are VIX-linked instruments, UVXY, a leverage product that reacts to short-term spikes in volatility, VXX, another product tied to VIX futures, often used to hedge or speculate. But a serious warning, these are not long-term holds. They suffer from something called decay due to how VIX futures are structured. You're paying a premium for protection, and if you hold too long, that premium erodes. Use these tools strategically and sparingly. They're more like emergency gear than everyday attire. From volatility to value, let's talk about how to tap into global trends with commodities and currencies. Commodities and currency ETFs give you access to macroeconomic themes without having to hold physical assets or open a Forex account. Why might you use these? To hedge against inflation, to diversify your portfolio beyond stocks and bonds, to speculate on global movements in things like oil, gold, or the US dollar. For example, GLD tracks gold, often used as a safe haven during market stress. USO tracks crude oil prices and gives you energy exposure. UP tracks the US dollar against a basket of foreign currencies. SLV, silver, part industrial, part precious metal. These instruments can perform well during times of uncertainty or when inflation fears are rising, but they also move based on global supply chains, geopolitics, and central bank policies. So be sure you understand the context you're trading in. Now let's explore some of the most aggressive and risky tools on the market, leveraged and inverse ETFs. Leveraged ETFs aim to multiply the daily returns of an index, usually 2 times or 3 times. Inverse ETFs do the opposite. They go up when the underlying index goes down. Some examples, TQQQ is 3 times daily return of QQQ. On the other hand, SQQQ is the 3 times inverse of QQQ. Then you have SPXU as the 3 times inverse of the S&P. SOXL brings 3 times daily return of the semiconductor index. But these instruments are not built for long-term holding. They reset daily, and because of something called volatility drag, your returns can erode over time, even if you were technically right about market direction. They're best used for short-term trades, speculative bets, fast-moving hedges. If you're using these, you need to monitor them closely. They're not a set-it-and-forget-it instrument. Think of them like a scalpel, precise, but dangerous if mishandled. Let's zoom out now and look at how all these tools come together to form a portfolio. Now that we've talked about what ETFs are, let's look behind the curtain at how they function. One of the reasons ETFs are so liquid and efficient is because of something called the creation and redemption process, powered by large financial institutions called authorized participants, or APS. Here's how it works. When demand for an ETF goes up, APS step in and bundle together the underlying assets like the 500 stocks in SPY and create new ETF shares. This prevents the ETF's price from running too far above its actual value, called the net asset value, or NAV. On the flip side, when ETF prices fall below their NAV, APS can redeem shares, exchanging them back for the underlying stocks. That stabilizes the ETF price and keeps it from collapsing. Pro tip, volume is not the same as liquidity. You might see an ETF with 1 million shares traded daily, But if the bid-ask spread is wide or APs aren't active, it might still be hard to enter or exit at a fair price. This structure is what allows ETFs to stay so efficient, even in volatile markets. It's a big reason they've exploded in popularity over the last decade. Of course, nothing is truly free. So let's talk about the real costs of using these tools. Whenever you use a financial instrument, you're paying for it, directly or indirectly. Let's talk about the two big costs you need to watch. First, the expense ratio. This is the annual fee charged by the fund provider. For ETFs like SPY, this might be as low as 0.09%. For niche or leveraged ETFs, it could be 0.75% or more. Over time. That difference adds up. Lower expenses equal to stronger compounding. Second, the slippage. This is the difference between your expected trade price and the actual execution price. It's worse in low volume or thinly traded ETFs, especially those with wide bid-ask spreads. It's also common in volatile markets or when placing large orders without limit prices. Always check trading volume spread width and the fund's turnover rate. High turnover equal to more internal trading, equal to more hidden costs in short. Keep your tool belt sharp, but keep it efficient. Every percentage point saved in cost is a percentage point gained in return. So now you know the tools, how they function, and what they cost. Let's bring it all together with portfolio construction. Now let's talk application. Financial instruments don't exist in a vacuum. They're pieces of a bigger system. Your portfolio should reflect a balance of four key objectives. We have growth or capital appreciation over time, protection aimed at hedging against market risks, income for steady cash flow, and diversification to reduce exposure to any single outcome. A thoughtful portfolio might include SPY or QQQ for growth, TLT or IEF for stability, VNQ for passive income, GLD or SLV as a hedge, UVXY or cash for volatility protection. But here's the key. It's not just what you include, it's how much. Risk allocation matters. Your exposure to tech should not be the same as your exposure to volatility. Your time horizon, goals, and emotional tolerance all shape that mix. It's less about having the right instrument and more about building the right system, one that adapts with you. Let's walk through two quick case studies where these tools come into play and the mindset that separates reactive traders from strategic ones. Let's walk through a realistic and unfortunately very common scenario. You've built a portfolio that's heavily weighted in tech. We're talking AAPL, QQ, maybe even some high growth plays like Archicam. It's been working for a while. Tech's been on a run, momentum is strong, and sentiment is optimistic. Then, boom, interest rates spike. Maybe the Fed comes out more hawkish than expected. Suddenly, the future cash flows that tech stocks are based on start getting discounted harder. Valuations compress. The portfolio you felt great about last week, it's down 8% to 12% in a matter of days. So what now? Here's where portfolio construction and your instrument knowledge becomes real. First option, shift exposure. Start rotating some capital out of growth-heavy positions into instruments like TLT or IEF. These bond ETFs typically benefit when the market seeks safety, though TLT, being longer duration, is more sensitive to rate changes. Next, you could add inflation-protected exposure like GLD. Gold tends to rise during uncertainty and often benefits from real interest rate pressure. It's not a perfect hedge, but it can stabilize the bleed. Want downside protection? Use SPXU, a 3 times inverse ETF on the S&P 500. Or buy puts on QQ to directly hedge your tech positions. Either way, you're using tools to manage risk rather than blindly riding the wave. And sometimes the move isn't an instrument, it's an exit. Trim exposure, raise cash. It's not emotional, it's tactical. Here's the deeper layer. You don't just want to respond, you want to reflect. Ask yourself, was I too concentrated in one sector? Did I ignore macro risk because of recent gains? Was I over relying on instruments that work great in bull markets but suffer in tightening cycles? This is where theory meets practice. Instruments help you execute, but your strategy and self awareness guides when to make the move. Let's look at another scenario that hits just as hard when volatility is coming, but direction is unclear. Now, picture this. It's the start of earnings season, or the Fed is about to announce interest rate policy. Markets have been moving sideways. You're holding SPY, QQQ, maybe even TQQQ, and you've got conviction in the trend, but there's tension in the air. You can feel the market is about to move, but you don't know which way. So what do? Option one, volatility plays. You pick up instruments like UVXY or VXX. These spike when volatility spikes, and they're a great way to profit from the fear itself, not the direction. But remember, these decay fast. They're for short-term hedges, not investments. Option two, defensive posture. Reduce your exposure. Trim some of your high beta names, move into cash or lower volatility ETFs. This doesn't mean you're bearish, it means you're cautious. And cash is a powerful position when everyone else is chasing moves. Option three, hedge the tail risk. Use SPXU or puts to protect your positions against a breakdown. This gives you breathing room without having to sell your core holdings. And if you're more advanced, maybe you go with a straddle, buying both a call and a put. If the market breaks hard in either direction, you profit. But if it stays flat, you lose both premiums. It's high risk, but when you time it right, it pays off. Here's the mental model to adopt. Are you trying to be right, or are you trying to prepare? Are you trading your opinion, or are you managing possibilities? You can't predict the market, but you can position yourself so that no matter what happens, up, down, or sideways, you're not wiped out. That's the mindset of someone who stays in the game long enough to win. And that's the heart of this week's message. These tools are powerful, but they're only as effective as the hands that wield them. All right, let's zoom out and look at the bigger picture. By now, you've learned a lot of individual tools: ETFs, REITs, bonds, volatility products, commodities. But here's where it all comes together: through market relationships. Financial markets are like an ecosystem. No asset moves in isolation. When one thing moves, it sets off a chain reaction. Your job isn't just to pick good instruments, it's to understand how they move in relation to each other and how to position accordingly. Let's break down some of the most important market relationships you'll see again and again, not just in theory, but in real market conditions. Consider interest rates versus bonds. This is one of the first relationships you need to understand. And it's deceptively simple. When interest rates go up, bond prices go down. Here's why: when new bonds are issued with higher yields, your existing bonds, which pay less, become less attractive. So the market adjusts by lowering their price. This effect is more extreme with long duration bonds, like what you get in the TLT ETF. Let's say the Fed hikes rates unexpectedly. Maybe inflation is running hot. In that case, TLT could drop sharply in a single session. But if the rate rise is slow and expected, the impact might be softer or already priced in. So what's the lesson? If you're holding bonds, especially long term, you're not just collecting interest, you're taking a macro position. You're betting on stability, on falling rates, or on risk aversion. That's why tools like IEF, 7 to 10 year duration, and shy 1 to 3 year duration exist. They allow you to scale your exposure based on how sensitive you want to be to rate changes. This relationship also explains why bonds can hedge stocks, but only in certain environments. So don't just look at yields, look at the why behind the yield movement. Now, let's explore stocks versus bonds, risk on versus risk off. You'll often hear traders talk about the market being in a risk on or risk off regime. What they mean is this: in risk on environments, investors are hungry for returns. They pile into growth stocks, tech, emerging markets, assets that offer upside, even if they come with volatility. Bonds in this case are not so attractive. Why lock in a 3% yield when the NASDAQ is flying? But in risk-off regimes where uncertainty rises, capital flows out of stocks and into perceived safe havens like US Treasuries. This causes stocks to fall and bonds to rise. That's the classic inverse correlation, but it's not guaranteed. Look at 2022. Inflation was rampant. The Fed was hiking aggressively. And guess what? Both stocks and bonds fell together. It was a rare regime where there was no place to hide unless you were in cash, commodities, or short duration assets. That's why understanding the why behind the fear matters. Is it inflation? Is it a recession? Is it geopolitical tension? Different fears call for different hedges. So the next time stocks are falling, don't just assume bonds will save you. Ask what's causing the move. That insight tells you whether to rotate, hedge, or stay put. Additionally, let's take a look at SPY and QQQ versus VIX or UVXY. Now we're getting into the emotional core of the market, volatility. The VIX or Fear Index measures expected volatility in the S&P 500. When markets drop, VIX usually spikes, and it spikes fast, but it's not reacting to price, it's reacting to uncertainty. Here's how it works. When traders anticipate a big move, up or down, they buy protection using options. That demand pushes up the prices of options premiums, which lifts the VIX. Now enter instruments like UVXY or VXX. These are ways to trade volatility itself. They're often used as hedges. So when SPY or QQ are falling, UVXY might be ripping plus 20% or more. But here's the trap. These products decay over time. Their value erodes in sideways or calm markets due to how they're structured. That's why you should never treat them as long-term holds. Volatility is a signal. It tells you when tension is building, but it's also a tool. And used correctly, it can protect your portfolio in moments of stress. Just be aware. These are surgical tools. You don't swing them around unless you know what you're cutting. Moving on to gold, GLD versus the US dollar, or UUP. Gold is one of the oldest stores of value, and it often moves in opposite directions from the US dollar. Why? Because gold is priced in dollars. When the dollar is strong, it takes more of another currency to buy the same amount of gold, which lowers demand globally. When the dollar weakens, gold becomes more attractive. But this relationship gets layered when we zoom out. Sometimes both the dollar and gold rise, like during a global shock when investors are desperate for safety. And sometimes both fall when risk appetite returns and cash flows into equities instead. So gold isn't just a hedge against currency, it's a hedge against confidence. Confidence in the economy, in fiat systems, in central banks. That's why it's part of many long-term portfolios. It doesn't produce yield, but it often preserves value when traditional assets are melting down. If you're trading macro or building a resilient portfolio, you need to understand this dance between GLD and UUP. One's an anchor, the other's a lifeboat. Let's take a further look at currencies, UUP and global impact. Let's stay with the dollar for a minute because the US dollar is one of the most powerful forces in global markets. The ETF UUP tracks the dollar against a basket of major currencies, and it can signal global capital flows, trade competitiveness, and investor sentiment. When the dollar is strong, imports are cheaper for U.S. consumers. U.S. companies with international exposure may struggle. Their foreign earnings translate into fewer dollars. Emerging markets suffer because many of them hold debt in US dollars, which becomes harder to repay. When the dollar weakens, commodities often rally, since most are priced in dollars. Multinationals benefit. Emerging markets breathe easier. Their debt burden softens and capital flows in. Currency ETFs like UUP, FXE for the euro, FXY for the yen, and CEW for emerging market currencies give you tools to hedge or speculate on these moves. And even if you're not actively trading currencies, you're affected by them if you own global equities, international bonds, or commodity funds. Don't ignore currencies. They're the invisible current that moves entire portfolios. Moving on to oil versus stocks, bonds, and inflation. Crude oil is a foundational commodity, and it moves markets in more ways than you'd think. Rising oil prices ripple through the entire economy. Consumers pay more at the pump, which reduces discretionary spending. Companies pay more for shipping, production, and logistics, which compresses margins. Inflation spikes, and with it, the risk of more aggressive Fed policy. If you're watching inflation, you should be watching USO, the ETF that tracks crude oil prices. Oil is also deeply geopolitical. A conflict in the Middle East, supply chain disruptions, OPEC cuts, these all create upward pressure on oil prices and affect sectors like energy, XLE, industrials, and even tech. Oil connects the dots between macro and micro. It hits the consumer, the producer, and the policymaker. And for you as a trader, it's often the first signal that something bigger is happening underneath the surface. Lastly, leveraged ETFs versus volatility in time. Let's talk about the wild cards. Leveraged and inverse ETFs like TQQQ, SOXL, SPXU, and SQQQ. These instruments amplify daily returns 2 times, 3 times, or invert them. So if QQQ is up 1%, TQQQ aims to be up 3%. If the market falls, SPXU might rise 3%. Sounds powerful, and it is. But these ETFs reset daily, which means they're not designed for long-term holding. They're tracking daily percentage moves, not long-term trends. In volatile or sideways markets, this creates something called volatility drag, a compounding effect where even if the underlying index finishes flat, your leveraged ETF could end down 10% over a few weeks. So what's the play? Use these tools when you have high conviction in a short-term move. You're able to monitor them closely. And when you're managing risk with stop losses or limits, these aren't core holdings, they're precision instruments. They can help you capitalize fast or cut deep if you're not careful. Know the terrain before you use them and think deep about what all of this means. It means that your edge isn't just in the ticker you choose, it's in how well you understand the environment around it. Markets are relational. Risk doesn't live in one trade, it lives in the connections between trades. Ask yourself, what's this instrument exposed to? What's its inverse? What macro force could cancel out my thesis? The more you understand the interplay between tools, the more adaptable, strategic, and successful you become. That's what we're building here, not just skill, but awareness. Now let's shift from the external to the internal and explore the mindset, philosophy, and emotional discipline that lets you actually use this knowledge when it counts. As you continue developing your edge, I want you to challenge your assumptions about risk, safety, and control. Here are this week's readings, Nassim Taleb, The Black Swan. We will focus on the prologue in chapters 1 to 2. Think about how outlier events, those you don't see coming, can devastate even the most carefully built portfolios. Cover the prompt. How might overconfidence in instruments like SPY, TLT, or UVXY give traders a false sense of safety or control? Seneca, Letters from a Stoic. Read letter 13 and letter 18. This is about emotional grounding, preparing for loss, detaching from outcomes. Prompt. What's more dangerous to your portfolio, the volatility of the market or the volatility of your mind? Daniel Kahneman, Thinking Fast and Slow, Chapter 20, The Illusion of Validity. Think about the prompt. How do fast emotional instincts lead traders into risky decisions when using leveraged or inverse ETFs? Lastly, Mark Douglas, Trading in the Zone. Read chapters 3 and 5, Taking Responsibility in Thinking in Probabilities. Then think about the prompt. When we rely on instruments to protect us, what beliefs are we outsourcing? And what happens when those beliefs fail? These reflections are as important as any chart or trade setup. They help build the mindset of a resilient trader. All right, let's wrap it up. So today we covered a lot. We went deep on the instruments, ETFs, mutual funds, options, bonds, REITs, commodities, volatility products, and more. But the real value comes from how you use them, not just to chase returns, but to design a system that reflects your strategy, your risk tolerance, and your time horizon. Remember, there's no perfect instrument. There's only the right one for the right moment and the mindset to know when to use it. If you have any questions about today's content, submit them using the QR code on your screen. I'll be responding in the next session or via Discord. And as always, like, comment, and subscribe to stay in the loop. You can find the links to our free Discord group and social channels in the video description below. Until next time, keep sharpening your edge